Good morning. Welcome to today's webinar, Maximizing Your 2025 Real Estate Tax Benefits. Effective January 20th of this year, sweeping tax law changes have created unprecedented opportunities for real estate investors and property owners. These aren't minor adjustments. They're provisions that could significantly impact your bottom line. We'll have time today for Q&A at the end of today's session, but if we don't answer your question, or if you'd like to take a deeper, more personalized dive into the information, please get in touch with us. Our presenter's contact info is in the bio section on your screen. To submit your questions, use the Q&A box in the lower left corner of your screen. Today's event will be recorded, and you will be emailed a copy of today's recording. Today's presenters are Antonio Ribeira, Principal and Market Leader, and Ben DiGirolamo, Principal and a member of the Tax Advisory Group. And now I will turn things over to Antonio and Ben to get us started.
Good morning, everybody. Thank you, Wayne. So again, my name is Antonio Ribeira. I'm a principal here at HBK. I'm the New Jersey market leader and then the firm's national practice leader for real estate. Ben.
Morning, everybody. Thanks so much for joining us. Ben DiGirolamo. I'm located in our Youngstown, Ohio office. I'm a principal in our tax advisory group, and I spend a lot of my time helping our clients understand the new law and specifically spend a lot of time working with real estate clients. So happy to be with you today.
Yeah, thank you for everybody for attending, and I just encourage you all to be interactive. Please feel free to ask questions. We're here to answer them. So we'll get this kicked off here. So just an agenda of some of the things that we want to cover today, just give a broad legislative overview, cover some business and individual tax provisions, talk about the estate and gift implications of the tax bill, talk a little bit about what's missing from the bill, and then go over some strategic items to consider moving forward. And then obviously we'll save time at the end for some Q&A for you guys. So the legislative overview and some context here. So the bill was signed last month and put into law. It's a mix of permanent and temporary provisions that were put into it. But I would say from a real estate point of view, I think the big thing here is some certainty, right? That there was a lot of very important provisions to the real estate industry that were set to sunset at the end of 2025. So the fact that we now know that some of these will exist for the next few years at least, that brings some stability, some permanence, and allows for some good planning for us. One thing that I'll emphasize throughout this is, even though these provisions are quote unquote permanent, right? It's always subject to some political risk, right? I would say that it's permanent while this administration is in the office. And when the next administration comes in, some of these permanent things could be taken away in an updated tax bill in the future. There's multiple effective dates for some of these provisions, so that's timing is critical there. But really, the real estate industry is hit at every level here, from acquisition to financing to operations. So it's a really broad impact. The bill as a whole was aimed at stimulating economic growth domestically here. So some key real estate themes, we're going to see an acceleration of deductions, right? The changes to the interest deduction rules are very beneficial, right? You're going to be a lot more, real estate in general is very leveraged, right? So this will allow us to take advantage of some of that interest deductibility. The qualified production property is a big piece of it that is aimed at stimulating American manufacturing. Opportunity zones are brought back / made permanent there. And then there's also a lot of interplay between Section 179 and then some of these pass-through entity tax deductions as well. So let's talk about the big one, right? For the real estate industry, bringing back 100% bonus depreciation was huge, right? That we had seen over the past couple of years was starting to go down from 100 to 80 to 60 to 40. And now it's brought back at 100% bonus depreciation for the current year for everything placed in service after January 19th, 2025. right? So that's one of those things where timing becomes critical, right? If you had placed a building in service on January 1st of this year, that really doesn't do us much good, right? It's only things placed in service after that January 19th, 2025 date. It covers anything that's got a useful life of 20 years or less. And this is where cost segregations are really critical, right? So for those of you that don't know what cost segregation is that you'll place a building in service, you will hire a company to perform a cost segregation study. So then rather than classifying everything as a 39-year piece of property, we can break down all of the subcomponents and assign different values to the 5, 7, 10, 15-year useful lives of things, and then accelerate that deduction. What I would expect moving forward is IRS audits to really focus in on those allocations of how you're breaking down that 39-year building into the different components. And that's where the cost segregations become critical, right? That it's not just someone, doing it themselves on the back of an envelope, right? It's that you're actually hiring a professional organization to come in and do it and assign those values for you. The other thing I would say there is just to watch out for any book-to-tax depreciations for those of you that aren't just looking at this from a tax perspective, right? But that also have GAAP requirements as well. There's some interchange there. The next piece of it here is the business interest expense limitation. So this is section 163J. This is a return to EBITDA, not EBIT, right? So for simplicity's sake, right, this is allowing us to add back depreciation and amortization to our calculation, which will allow for a lot more interest deductibility on these given projects. So really critical shift for the real estate industry where depreciation is a huge component of what we're doing. So especially in real estate where we're super highly leveraged in a lot of projects that are taking place, this will allow for more interest deductibility. Really critical in the REIT area as well. And like I mentioned before, leveraged developers. Ben, were you saying something there?
Yeah, Antonio, if you don't mind me jumping in. So this was something that was brand new under the Tax Cuts and Jobs Act. We hadn't really seen specific limits on the deductibility of business interest applying to domestic entities. But it was a revenue raiser that was part of the 2017 Act that's still in place going forward. And so not every business is subject to this limitation. There's a small taxpayer exception to 163J. So generally businesses that in aggregate across related entities have less than the new limit for 2025 is 30 million of average annual revenue. Then you're not subject to these same interest deductibility limitations. There's also those that even are small might get roped into this if they're a syndicated investment or viewed as a tax shelter. So there are some exceptions to it, but for those that are subject to 163J, the larger businesses or those that might be subject to it otherwise, this has been hugely impactful. And the change that we're talking about here wasn't something that was initially in play in 2017. In 2017, it initially was an EBIT calculation. So you look at EBITDA. You don't look at taxable income. You get to add back certain things to your taxable income, multiply that by 30%. That's how much interest you get to deduct. That changed kind of midstream during the Tax Cuts and Jobs Act, and we lost the add back of depreciation and amortization, meaning that your income level's lower, your 30% limit's lower. You don't get as much of an interest deduction. Now, thankfully, with the new bill, we see a return to the EBITDA calculation. So for those that are subject to the 163J calculation, being able to add back, as Antonio mentioned, that's potentially significant depreciation deductions is going to be huge. We've seen this all across our client base. Seen some get whipsawed by taking cost segregation studies. You get the benefit from the accelerated depreciation and the bonus, but on the flip side, you might lose some of that interest deductibility, which kind of offset the benefit. This ability to add back starting in 2025, the depreciation deductions will alleviate a lot of that stress.
Yeah, thanks, Ben. I would add two more points to that. Is one, and Ben briefly mentioned it there. You are looked across. There's an aggregation component to it too, right? So that's a significant part of planning that you should be doing, is looking across all of your entities, not looking at each of them in an individual silo. And then the other thing that I would point out here is there is still long-term risk associated with this if interest rates were to rise again, right? That could significantly impact the deductibility there, or if there's a softening in your EBITDA moving forward as well due to some economic downturn. So it's not foolproof, but it certainly should have a great impact on our real estate businesses. Ben, I'm going to kick this one over to you.
Sure. Yeah. So this is a brand new concept and provision of the Tax Act. So much of the Act is extensions of what we saw from the 2017 bill that were scheduled to expire. But we also got some brand new things, and this is one of them. The qualified production property deduction is something that's intended to help entice and invigorate domestic manufacturing. And it's doing that by allowing an elective deduction, 100% deduction of the cost of real property that's utilized in manufacturing. So a brand new concept. As Antonio mentioned before, you're probably familiar with the concept of a cost segregation study. Why did we do cost segregation studies? Because a non-residential building has a recovery period of 39 years, which can be somewhat penalizing in the real estate industry, only being able to recover your cost of real property over 39 years. So the cost segregation study allows us to peel off certain real and personal property that might be eligible for an accelerated depreciation. This new classification of property says that even if it is in the 39-year bucket, the real property that's wouldn't otherwise be eligible for acceleration, if it's associated with manufacturing and it meets the definition of qualified production property, at the election of the taxpayer, that 39-year property can be deducted 100% in the year that it's placed in service. This is not a permanent extension. This is basically a 4-year extension. You see some of those dates, the 29 and 31 dates that we're going to be dealing with as we get towards the end of this. But for now, a huge benefit to those in the manufacturing industry who might be looking at acquiring existing. The existing can potentially benefit building new buildings or expanding on their existing manufacturing. And so what does this mean as it relates to, the real estate industry? A lot of owners of manufacturing plants also own their real estate and are making those improvements themselves. Unfortunately, for landlords, there's a specific exclusion from the benefit of qualified production property. So the rule says that you don't get to look through to what the tenant is doing with that property, even if they are manufacturing it. If the landlord is paying for those improvements, it's not qualified production property. And one of the problems we see with that right now is there's no exception for self-rentals. So a very common practice in business, it's done for good business, legal and tax purposes, is to separate the real estate from the operating business, often holding that real estate in a related partnership. If these improvements that would otherwise be eligible for qualified production property are made in the related real estate entity and the landlord, they're not going to qualify for the 100% depreciation deduction. And so for those businesses that we're working with right now that might be considering these projects or midstream with these projects, we're looking at how we can make sure that they're being made in the operating business to qualify for the production property deduction. And for landlords, you might not get it. Now, this is just my opinion. I mean, we may see some changes, hopefully with at least the self-rental, but I could also see a push to do away with the lease exception in its entirety, because in my opinion, again, just mine, if the idea is let's entice domestic manufacturing, then why should it matter if I choose to finance my production facility through a lease and have somebody else, unrelated party, be the landlord to put that building into place? Why shouldn't the landlord be able to benefit if they're assisting in that creation of domestic manufacturing? So I don't know if anything's on the horizon. Maybe that's just my hope. Hopefully we get a relief on the self-rentals, on the related party rents, and then maybe it could even be expanded as well.
Ben, could you talk a little bit to the adaptive reuse aspect of it here? I know there was the term in there, substantial transformation, but I don't think we've received any guidance at this point as to what qualifies as substantive transformation.
Yeah, so there's going to be a lot of questions here and some gray area, I imagine, on what exactly is manufacturing, which and what isn't. I mean, I think there's, the GMs and the Fords, we know they're manufacturing cars, right? But some other nuanced areas, we're getting questions from breweries and wineries and farms, things that might be done inside. Are they qualified for manufacturing? Absolutely, they could be. There's some more nuanced things there. So we have a very broad definition right now that I think points to some historic legislation or some historic legislation with the tax code. But yeah, we expect to see some more guidance issued from the Treasury about helping us determine what exactly would qualify as manufacturing buildings. I should also mention that it's not necessarily the entire building. You're going to have to be specific about what portion of the building or percentage is used for manufacturing, because the law says specifically that areas used for R&D, areas used for administrative purposes are not going to qualify. So you'd probably have to quantify what's the percentage of my office space versus my manufacturing space to determine how much is eligible for that deduction.
Yeah, and that's where I'd say where the cost segregations then come back into the picture, and they're huge components of this, because the expectation would be if you're hiring a company to do a cost segregation for you, they would be giving you those percentages of X amount is office and X amount is manufacturing.
Absolutely.
So moving on to the next slide here is the expansion of Section 179. So the limit was increased to 2.5 million, and the phase out now starts at 4 million, and this will be indexed for inflation starting after next year. Section 179 is huge because there is state conformity in some states throughout the country, right? Where in most cases, bonus is not applied down to the state level. This is huge for some of those high tax coastal states, like where I am in New Jersey, New York, California, where there is an allowance for Section 179, but there is no allowance for bonus depreciation at these state levels. This is also really helpful for some of our smaller real estate operators that are in more equipment heavy industries. Think the hospitality space, self-storage. So there's a lot of planning that gets involved here of how are we not just maximizing your deductions at the federal level, but how could the federal and state interact with each other to make sure you're winding up in the best position from an overall perspective, not just federal, and then getting whacked at the state level. The other added piece to this is you should really consider layering your Section 179 deductions with your energy efficient deductions as well, because then you get a compounding effect for those two. The opportunity zones, they were made permanent. Ben, I know you have some significant experience with opportunity zones, so I'll let you weigh in on this one.
Yeah, this was another thing that was brand new in 2017 with the Tax Cuts and Jobs Act. And there's some significant tax benefits that can come along with making investments into opportunity zone businesses and opportunity zone funds. That benefit was basically going away, or is scheduled to go away with 2026. We have a little bit of a gap in the benefit, and now under the new bill, it springs back with some key changes starting in 2017. And I think it's really important that everybody kind of understands the benefits that are out there related to opportunity zones, because now we have this permanent extension, and there are some significant investment in tax savings opportunities that can occur through investments in opportunity zones. Kind of going back to 2017, the initial response that we got was, I have property in an opportunity zone. What can I do to benefit from this? So let's talk specifically about the benefits that are under the existing and now this new opportunity zone classification of property. One way to think about this, there's some similarities, and they're often referred to or looked at the same time as a 1031. which is something that I'm sure a lot of you are familiar with, that allows for deferral of gain when I'm selling real property. I can roll that gain, those gain proceeds into new or existing business use or investment property and defer gains. Opportunity zones start with a gain that I can now defer by investing into an opportunity zone business or opportunity zone fund. So there's two stages of benefits, and this often gets mixed up, but really important. Once you understand it, I think you get it. There's two benefits of making an opportunity zone fund. One, or opportunity zone investment. It starts with a gain, any type of capital gain. Any type of capital gain. Doesn't have to just be real estate. Can be sales of stock, can be sales of business property, can be sales of real estate. Any type of gain that I have on my tax return as a business or an individual, I can roll dollar for dollar into an investment in an opportunity zone business or fund. Let me step back for a second. The federal government said, here's this opportunity, states. It's a new investment opportunity with tax benefits that we're calling opportunity zones. You get to identify what areas within your state you want to be opportunity zones to help entice this investment. And so states did this in very different ways. Every state's probably a little bit different in where you're seeing they identified certain opportunity zones. I happen to be close to Youngstown, Ohio. I think pretty much the entire city of Youngstown was designated as an opportunity zone. So we had lots of clients when this initially came out saying, I have property in this opportunity zone. What can I do? What can I do to benefit? Well, let's go back to the benefits. One, it starts with, as a taxpayer business, I must have a gain from the sale of something. Let's say I sold a piece of real estate and my gain was $100,000. Unlike the 1031, much more or much less restrictive, I don't have to use a qualified intermediary. I can actually take the cash and then I can reinvest dollar for dollar the gain, not the entire proceeds, to defer that $100,000. So if I take $100,000 of cash and put it into an opportunity zone business or fund, I will defer that $100,000 of gain. That's benefit one. Under the old rules, which we're still under, that are revived for 2027, that deferral lasted until 2026. So you can still make an opportunity zone business or fund investment today to defer tax from your 2025 return, but you're just kicking it down to 2026. That initial benefit started in 2017, and so the longer you went, the less of a deferral you got because we had a cliff of 2026, but you got to defer your initial gain. The second benefit of an opportunity zone investment is that if I hold that investment, so now I've deferred my gain, let's say I made it in 2025, I've deferred my $100,000 gain by investing in an opportunity zone fund or business to 2026. I now have this $100,000 investment in this opportunity zone fund or business. If I hold that investment, I'm going to pay tax on my initial $100,000 gain in 2026. I deferred it 1 year. But if I hold that $100,000 investment for 10 years before selling it, whatever that grows to, let's say it's worth $500,000 after 10 years, that increase in value from $100,000 to $500,000, I don't have to pay tax on it. Let me back up. So two separate benefits. My initial gain, dollar for dollar, I can defer it to 2026 by investing in an opportunity zone fund or business. That's benefit one. I will pay tax on that though. Then the appreciation, if I hold the investment for an additional 10 years, that appreciation is not subject to tax. So that's the rules as they existed under the Tax Cuts and Jobs Act. We now have a return of the opportunity zone funds and businesses, which is now made permanent. And it's made permanent starting in 2027. Instead of now having a cliff year that was 5 or 6 years down the road, it's a rolling deferral. So if we compare to what I just said, if I have that $100,000 gain in 2027 and I invested in an opportunity zone fund or business in 2027, I will defer that gain for 5 years to 2032. Not only will I defer that gain, I'll also get to exclude 10% of the initial gain so long as I hold it for 5 years. If I sell it midstream, I'm going to have to pay tax. But if I hold it for 5 years, I don't have to pay tax until 5 years. and I'm only going to pay tax on $90,000, not the full $100,000. In addition to that, we still have this second benefit, which says that if I hold on to that investment for 10 years, the gain can be 100% excluded. So, what does this mean for you guys, and why do I say it's so important? I think that this becomes a part of everybody's planning. Anytime you see a taxpayer business with significant gain that they're going to recognize, we should be looking into these investment opportunities. And we're really seeing them in two separate ways. One is kind of the scenario I mentioned before. You're a landlord and you already own, or you're a real estate owner and you already own real estate in an opportunity zone. What does this mean for you? Well, it doesn't directly mean anything, right? Because already just owning the real estate in an opportunity zone fund doesn't get you anything. But you could make investments. If you have a gain, you could invest dollars into a business within that opportunity zone and create your own opportunity zone business or fund to benefit from that. That's one of the benefits. Two, your real estate might be worth more now, and if it's in an opportunity zone, because somebody else might want to buy it from you because they want to make one of these investments or opportunities. And then really the thing that we're probably seeing the most is that there's groups out there that are creating these opportunity zone funds for you, and they're readily available to invest in. And so for us and for our clients, certainly 1031 is still an option. You might have heard of Delaware Statutory Trust. That can be a way to find a readily available investment for a 1031 if you don't want to do direct ownership yourself. These opportunity zone funds investments are often kind of marketed together with those DST investments because you can do it with real estate and it may make more sense, but you can do it really with anything. So there's readily available funds for you to invest in. Again, so anybody who's got a significant gain that they're going to recognize on their tax return should be considering whether or not one of these types of investments, which going forward, starting in 2027, is going to allow them to defer that gain for 5 years. And then if they hold that investment for 10 years, they may be able to escape gain altogether. So we've had a lot of these discussions with our clients. We have a related company, HBK Wealth, that's helped a number of our clients vet these investment opportunities, and we'd be happy to do that for you as well.
Yeah, the two things that I'll add to this is if you were to start your own QOZ entity, the compliance burden associated with that is quite heavy. Versus if you make an investment into a fund, the fund is handling the compliance piece and you're just handling your own individual tax reporting component of it. So that is a big consideration. If you were to go out and try to do this on your own, there is a significant compliance piece to this. And then the other part that I mentioned too is you still have the opportunity that you can stack this qualified opportunity zone with some of those tax credits that exist out there, the low income tax, the green energy credits, that you can layer up those two together. Moving on here to the next slide. So a lot of our real estate investors are structured in partnerships, which then means that they're flowing through their income to their personal tax returns. That's why some of these individual tax provisions have a significant impact to our real estate clients. The biggest one, the hottest topic as this was going through Congress, was this SALT cap. That was something that they could not seem to agree on, but did find an agreement here at $40,000 as the SALT cap. So this was introduced back at the Tax Cuts and Jobs Act, and it limited your state and local tax deductions on your federal return to $10,000. This had a significant impact to, again, those coastal high tax states. I looked at the attendee list before we jumped on here, and I did see we had a number of New Yorkers on as attenders today. Huge benefit to the folks in New York. The fact that we saw this cap raise up to 40,000, and then this will be inflation adjusted moving forward as well, and it expires in 2029. Again, back to that what I had said in the beginning, that there's permanent and temporary ones. This is part of the temporary. The PTE deduction is still going to be allowed. There was talk about some carve out that we weren't going to allow the pass-through entity tax deductions. So the fact that this is still allowed is still a huge value add opportunity for our business owners, that if they're going to be in excess of that 40,000, or where they would get limited with their state and local deductions on their individual return, that we can still take advantage of these deductions at the entity level and pass them through to the individual level. The qualified business income deduction, there's higher phase-in thresholds. More will then qualify for this QBI deduction. That was also introduced in the Tax Cuts and Jobs Act and now made permanent here. So that is a really beneficial one as well. And then lastly, the excess business loss limitation, that was made permanent. So more investors will then be able to take advantage of that deduction there. Flowing in from individual to the estate and gift planning, this was another really hot topic as part of this tax bill, that the lifetime exemption was raised to $15 million per person, and this will be indexed for inflation every year. This locks in that historically high lifetime gifting capacity and is huge for our real estate clients, right? Especially now in this environment where interest rates are higher than they've been in the past couple of years, we can take advantage of these higher rates to assign lower values to our real estate to then gift them in to whether it's grantor trusts or non-grantor trusts. Take advantage of it, get it outside of your estate, protect it from that estate tax. But this is a really key window here, right, where we can take advantage of that. One of the things that we had been doing as a firm was really stressing that estate planning leading up into the end of 2025, because that's when the exemption was set to come cratering down to in the 4 to 5 million mark. So the fact that this remains high is very good for our wealthy business owners, and we should continue to take advantage of these estate planning opportunities to protect yourself from the estate tax. So what's missing from the bill? There was a lot of talk initially about removing the 1031 provisions and basically removing 1031 and not allowing you to use that tool as a tax deferral mechanism. Luckily for us, big sigh of relief that the 1031 exchange rules stayed intact. They weren't changed at all. There was no carried interest change, so this was a big positive for private equity companies and real estate fund managers as well. Then the low income tax credit was expanded and some of the green energy credits were modified. The low income tax credit, I think it increased, right? But I don't think it increased as much as folks were hoping. It still doesn't really address the demand that's needed for affordable housing. That's a hot topic here in New Jersey. There is a shortage of housing. It's something that if you're local here, you're reading the news constantly about affordable housing and the fights that are happening between the local municipalities and the towns. So the local municipalities and the state. So this is an incentive for business owners to continue to develop that low income affordable housing. Those green credits, if you were taking advantage of those credits, it's really important now to maximize them in the short term. Or change your pro forma as your projections moving forward, because there's components of them that are going away altogether. So some of the strategic planning, making sure that you're timing your acquisitions correctly to maximize and take advantage of the bonus depreciation. Consider those qualified opportunity zone opportunities. Look at your financing models under the new 163J regulations. Making sure you're continuing to evaluate those pass-through entity tax deductions, and then obviously updating your estate plans to make sure that you're protected and your next generation is protected as well. So that is it from us as far as the webinar goes, but we're open now for some Q&A. I hope everybody has got some Q&A for us. Wayne, I can't see the Q&A box, so if you want to read me through any of the ones that come in.
Absolutely, sir. Taking a look here now. Currently no questions, but yes, if anyone does have anything they'd like to submit or discuss, please take this opportunity to do so. Let's see here. And since we have arrived at sort of the end of the official version of this training, I'll provide some closing housekeeping remarks now, just to give everyone a chance to, formulate your thoughts, your questions, and submit anything you'd like to submit, as we a portion of this event. Oh, and it looks like one just came through. I'm thinking about converting some rental units to short-term rentals. Are there different tax considerations with these new rules?
So there is, right? So when you're converting from a long-term rental to a short-term rental, you need to look to make sure that you're not going to be considered active, right? And once you become an active business, you're subject to those self-employment rules versus passive businesses are not. So that's a big consideration there that requires some planning. But you would be able to take advantage of those deductions like the bonus depreciation, cost segs, some of the energy efficient credits. Those would all be applicable to you.
Fantastic. And I think we're just waiting to see if anything else comes through. And while we do, again, I can just remarks. Just to thank, of course, Antonio and Ben for their helpful information here today, and to thank everyone who's attended as well. And I would just like to remind everyone that you will be receiving a copy of the recording of today's event. And I see some more questions that just came in, so I'll pass this along to our presenters momentarily. But I just want to say to everyone else attending that, if this is not, if you don't have your question right now formulated and you'd like to connect with our presenters later on, their contact info is available in the bio widget that's on your screen right now. So you can always get in touch with them following today's event if you don't have your question currently. Let's see.
Wayne, I'm seeing the question that just came through, so I can handle this one. Yeah, so the question is on the new qualified opportunity zone rules. The person wanted to confirm, in addition to the full exclusion with the 10-year holding period, there's also an exclusion of the initial gain. The initial gain is not excluded. The initial gain is deferred. So under the new rules, starting in 2027, you have a rolling 5-year deferral of your initial gain. You will pay tax on that initial gain after 5 years, but you pay tax on 90% of it. You get a 10% bump in your basis so long as you hold it for 5 years. The appreciation is what can be fully excluded on that initial investment if you hold it for 10 years. And I'm not seeing any other. I might be missing some, Wayne, but I'm not seeing any others.
No,
I figured out how to pull it up. That's the only one that I see as well.
Yep, same. Can confirm that. Okay. Well, as we stated, yes, if you do have questions, feel free to submit now or can always submit later. And just a final note on my part that I always like to share is that no one needs to actually log out of this section today. And there will definitely be more information about the OBBBA to come. So please keep an eye out for that. Gentlemen, is there any other additional information you'd like to share at this point?
No, thank you for everybody for attending.
Okay. Yes. Thanks very much for your time, everyone. Have a great day.